Financial ratio analysis is a key tool for assessing the creditworthiness of borrowers in the lending business. It helps lenders evaluate a company's financial health, ability to meet debt obligations, and overall risk profile. Below are the key financial ratios used in lending decisions. Hop 1. Liquidity ratios, short term solvency. These ratios measure a company's ability to meet short term obligations. Current ratio, current assets, current liabilities, indicates the ability to pay short term liabilities with current assets. A ratio 2:1 is generally preferred. Quick ratio, acid test ratio, equal current assets inventory, current liabilities, a stricter measure of liquidity as it excludes inventory, which may not be easily converted into cash. Cash ratio, equal cash and cash equivalents, current liabilities, measures the ability to pay short term obligations with cash only. 2. Leverage ratios, debt management. These ratios evaluate the financial risk by measuring debt levels. Debt to equity ratio equals total debt shareholders' equity. Higher ratios indicate higher financial risk. Lenders prefer lower ratios, but industry benchmarks vary. Debt to total assets ratio. Total debt, total assets, measures the proportion of assets financed through debt. Interest coverage ratio, EBIT, interest expense, assesses the ability to pay interest obligations. A ratio by and to is generally preferred. Debt service coverage ratio, DSCR, equals EBITDA, interest plus principal repayments, a key ratio in lending indicating the ability to cover debt obligations. 3. Profitability ratios. These ratios measure the borrower's ability to generate profits. Gross profit margin equals revenue, cost of goods sold. Question: revenue measures profitability after direct costs. Operating profit margin equals operating profit EBIT revenue, assesses operational efficiency. Net profit margin in net income revenue indicates overall profitability after all expenses. Return on assets ROA equals net income total assets, measures how efficiently assets generate profit. Return on equity equals net income slash shareholders equity, evaluates profitability relative to shareholders' investment. 4. Efficiency ratios, asset utilization. These ratios analyze how well a company manages its assets. Receivables turnover equals revenue accounts receivable. Higher turnover means faster collection of receivables. Inventory turnover, cost of goods sold, average inventory, measures inventory efficiency. Higher ratios are preferred. Asset turnover ratio equals revenue total assets, assesses how efficiently assets generate revenue. Cash flow ratios. Since cash flow is critical for loan repayment, these ratios provide insights into liquidity and solvency. Operating cash flow to debt ratio equals operating cash flow total debt, indicates the ability to service debt with cash flow from operations. Free cash flow to firm FCFF, operating cash flow, capital expenditures, measures the cash available after maintaining capital investments. Application and lending decisions. Lenders use these ratios to assess financial health before approving loans, determine risk levels and interest rates, set loan covenants to mitigate risks, monitor borrowers post-lending to ensure financial stability. Would you like an example?